What is the 4% rule? Well, back in the 1990s, financial advisors were telling their clients that if your portfolio makes 8% a year, you can take 8% out. The problem with that is that if people got what's called a bad sequence of returns, even if they had 8% average returns throughout their retirement, if the bad years came first, if this sequence of returns risk showed up, they ran out of money. So despite the portfolio making 8% a year, they ran out of money because they were having bad returns. The portfolio was losing money and they were taking money out at the same time. And they ended up, a bust in retirement. So some researchers started thinking about this and they're like, well, we got to be able to account for bad sequences of returns. So obviously we have to withdraw less than the portfolio is returning on average in order to make sure our money lasts throughout retirement. How much less do we have to withdraw in order to make sure that happens? So they thought, well, let's design a study and let's try to figure this out. Let's go back and look at all the past returns we have in any sort of reliable database of stocks and bonds. And so they looked for databases and they said, well, the most reliable one we have goes back to 1927. That's not all that much time. That's not even 100 years. So we'll use rolling 30-year periods, starting in 1927 through 1957, 1928 through 1958. And they looked at all of these rolling 30-year time periods and imagined that a retiree that retired in that year started withdrawing money from the account, adjusting upward each year for inflation. They said, well, let's start at, 3%. They'll take out 3% of the account and 4% and 5% and 6, 7, 8, 9, 10, 11, 12. And what is the likelihood that they run out of money historically if they did this? And so this study is famously known as the Trinity study because it was done at Trinity University down in Texas. And if you haven't looked at the money shot from this study ever in your life, I put it in all kinds of blog posts and presentations, but the money shot is table 2. And it's labeled retirement portfolio success rates by withdrawal rate, portfolio composition, and payout period in which withdrawals are adjusted for inflation. And if you spend some time with that, you will quickly realize where the 4% rule comes from. For example, if you look up at a portfolio that is 50% stocks and 50% bonds over a 30-year time period, historically, and this is updated, I think they updated it in 2009, so this is updated since they did the original study, but historically, if you took out 3% of that portfolio a year, adjusted upward for inflation, none of the portfolios ran out of money. There was no rolling 30-year time period in which you ran out of money. Same deal, 50% stocks, 50% bonds. If you took out 4% of the portfolio, you ran out of money just 4% of the time, 4% of those rolling 30-year scenarios. However, if you bump it up to 5%, you ran out of money a third of the time. If you bump it up to 6%, you run out of money half the time. If you bump it up to 7%, you run out of money 80% of the time. And if you bump it up to 8%, what financial advisors were telling people they could do in the 90s, you ran out of money over 90% of the time. Okay? So that's where the 4% rule comes from. 4% rule, 4% guideline, whatever. Now, keep in mind, this takes into account a lot of very terrible economic situations. The Great Depression is included in this data. World War II included in this data. The Korean War included in this data, right? The stagflation of the 70s, Vietnam, 9/11, right? That terrible day in 1987 when the market lost whatever it was, 27% of its value. The dot-com crash, the 2008 global financial crisis. This is all included in the data. And even so, 4% works essentially all of the time. So that's where the 4% rule comes from. And the cool thing about it is you can reverse engineer it. If you know you can take out about 4% of your portfolio, you know that you need about 25 times what you spend in order to retire. So if you're spending $100,000 a year, you need 2.5 million. If you're spending $200,000 a year, you need 5 million. Okay? And so you can reverse engineer and figure out how much you need to retire. Now, is this method like the recommended method for how you should spend your money in retirement? No. No, I know basically nobody doing this that takes out 4%, adjusts it up for inflation each year, and takes out, 4% plus whatever inflation was the year. Nobody does that. Everybody adjusts as they go. If sequence of return risks shows up, you tighten the belt a little bit. Most of the time it doesn't show up, and so you can spend a little bit more, or you end up leaving more for your heirs behind than you thought. On average, somebody who did this, who took out 4%, adjusted up each year for inflation, leaves behind 2.7 times what they retire with on average after 30 years, right? If you die sooner, you leave behind even more, right? So most of the time, you end up with far more money than you need. So if this bad sequence doesn't show up in the first 5 or 10 years of your retirement, you can loosen the purse strings and start spending more. And if it does, then you've got to, tighten your belt a little bit and realize you're one of those situations that really can only spend about 4%. Some people think because yields have come down, because maybe future stock returns won't be as high, that 3% is the new 4%. Or some people get insane and start talking about 2% and 2.5%. But the truth is, even if you want to be really conservative, you dial it back to 3.75 or 3.5 to start with, and then adjust as you go. That's going to be plenty. But if you've never heard about the 4% rule, that's basically what it is. And the cool thing about it is that gives you a number for retirement. Retirement is not an age, it's a number. It's an amount of assets. It's 25 times what you are spending or want to spend in retirement. And you can hit that when you're 35 or 40 or 45 or 50 or 55 or 80. Right? Just because the government says you can't have Social Security until you're 62 doesn't mean you got to wait till you're 62 to retire. Or just because they say you can't have your full Social Security benefit until you're 70. You don't have to wait until 70 to retire. When you have enough money, you can retire if you want to. Otherwise, you can just enjoy the benefits of being financially independent and still working like I am. And it provides a lot of freedom in your life. It's very nice. Trust me, medicine's a lot more fun to practice when you don't need to practice it.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.